Today, strange Attractors. Market update for the 20th of November 2021. Hello again, it's Martin North from Digital Finance Analytics World, and this post covering finance and property news with a distinctively Australian flavour. In today's show, we have a brief look at the markets as the contention between inflation fears, rate rises and more lockdowns rose to fever pitch, pun intended. The markets are still banking on more central bank support, of course. The S&P 500 rose 0.14% to end at 4,697, while the NASDAQ Composite gained 0.4% to 16,057, and the Dow Jones Industrial Average fell 0.75% to 35,601. So the NASDAQ Composite Index closed above the 16,000 mark for the first time on Friday, and that's its second straight record finish, while the Dow succumbed to its fourth losing session in the last 5 days. The Dow Jones Industrial Average's second successive weekly loss wiped out the last of its November gains, extending the index's fall from November the 8th, when it recorded a record high. Overall, both the NASDAQ and the S&P 500 index scored a winning week after last week's decline snapped a 5-week run of higher finishes. Friday's fall was caused by banking, energy and airline stocks slumping on fears of new lockdowns in Europe to curb a resurgence of COVID-19 cases. Austria said it would reimpose a nationwide lockdown on Monday to curb surging COVID-19 cases, rising concerns about the impact on the global economy as larger economies in the bloc, including Germany, could also introduce fresh restrictions. Banking stocks fell, tracking a drop in Treasury yields as investors snapped up safe haven bonds. US financials were amongst the worst performing S&P sectors. Carriers including Delta Airlines, United Airlines and American Airlines, and cruise liners Norwegian Cruise Lines and Carnival all dropped. Major oil firms dropped as well as crude prices fell on renewed concerns over European demand, making the S&P energy sector the worst performing among its peers. It's a normal time to take risk off, and in this case there's just so much liquidity that the market doesn't go down, just people take risk off by going into safe havens, said Jay Hatfield, Chief Executive of Infrastructure Capital Management in New York. Right now, COVID-19 is kind of a headline of the day. Every trade in the market right now is being driven by COVID. Falling yields and safe haven demand supported major technology stocks, though, which in turn lifted the NASDAQ. Tech stocks, of course, are sensitive to yields as investors weigh future earnings in the sector against returns on debt. Netflix gained along with other stay-at-home stocks. The IT segment was the best performer on the S&P 500. Cisco Systems, the company specializing in the supply of networking equipment, fell after releasing revenues which were down $12.9 billion compared to analyst expectations of $12.98 billion. Cisco is addressing some supply chain problems, they said. Nvidia, the largest company in the chip industry in terms of capitalization at $731 billion, presented indications on the revenues of the far above analyst expectations, $7.4 billion against the expected $6.9 billion. The choice to focus on chips installed in data centers is rewarding. Intuit led the move higher in tech after the business software company reported fiscal first quarter results that beat on both the top and bottom lines. The positive results sparked a wave of the bullish price target upgrades on Wall Street, with Deutsche Bank lifting its price target of Intuit to $780 from $700. The S&P consumer discretionary sector ended at a closing peak for a second day in a row, having also broken its lifetime intraday high on Friday as well. This follows strong retail earnings this week and positive signs for holiday shopping in the US. Lowe's companies rose to its third successive record close after reporting third quarter results on Wednesday. ETSY Inc., which posted earnings earlier in the month, achieved the same closing feat. Macy's was up 19% after the quarterly report came in above expectations. The department store closed with sales up 36% and a profit of $239 million compared to a loss of $91 million in the same period last year. The gains in consumer discretionary stocks, one of the best performing sectors this week, continue with Nike and Tesla up more than 2% and 3% respectively. Adding to the broader market angst, Federal Reserve Vice Chair Richard Clarender said it may be appropriate for Fed members to consider whether to speed up the tapering of bond buying next month amid elevated inflation and an ongoing recovery in the labour market. The Volatility Index, which measures the implied volatility of the S&P 500, was up 1.82% to 1791. Gold futures for December delivery was down 0.7% to 1,848, and crude oil for delivery in January fell 3.47% to 75.69. That's on concerns that fresh restrictions in Europe will dent oil demand. The euro-US dollar was down 0.73% to 1.1286, and the US dollar futures index was up 0.53% to 96.05. On the political front, the House of Representatives passed President Biden's $1.75 trillion human infrastructure package, or Build Back Better Act. The legislative measures will progress to the Senate, where Democrats hope to pass it using the budget reconciliation process without Republican support. The bill will likely have to be revised as centrists such as Senator Joe Manchin of West Virginia have balked at its hefty price tag and questions claim the initiative was fully paid for. The bill would contribute $791 billion to the deficit in the next 5 years and $367 billion to the deficit over the coming 10-year period, said the Congressional Budget Office. And it's not clear exactly when the debt ceiling will be reached in the US, but it is being played. The Democrats do not want to lift it through the reconciliation process, though they have forced the Republicans to do so in the past. The Republicans appear to have the discipline and will oppose. No one seems to think the US will really default, and getting even this close seems undignified, yet the desire to avoid being caught out encouraged investors to demand a high yield on the 4-week bill sold yesterday. The auction saw the yield more than double to 11 basis points annualized. It's the highest yield since July 2020, and in contrast, the 8-week bill, which is thought to be beyond the shenanigans, priced at 4.5 basis points from 6 previously, and there was a higher bid cover ratio. And in Europe, the Euro Stoxx 50 was down around 1%, the FTSE down 0.7%, and the DAX down 0.5%. The stock market picture remains set for the upside, even if the pandemic numbers are starting to become worrying in some regions. The Europe Stoxx 600 snapped a 6-day advance yesterday in response to that. It's the only second-time loss since October. It began firming earlier in the day, but reversed once the COVID news spilled out. Infections, in fact, have been declining since July in Africa, the Middle East and Southeast Asia, while the World Health Organization reports that Europe is the only region in the world where deaths are rising. Over 3.3 million new infections have been registered, 2.1 million of which are on the European continent. The highest infections were recorded in Russia, Germany, and the United Kingdom, while deaths rose by 67% in Norway and 38% in Slovakia. The 7th consecutive week that infections from COVID-19 continue to increase in the 61 countries that the World Health Organization counts in the European region, which also covers Russia. And it's highly probable that with numbers of this kind, some governments will be forced to intervene with more drastic measures than those already adopted today. The stronger than expected October retail sales capped the week's data that points to a rebounding economy, though, in Europe, and boosted the chance of a rate hike next month. A strong jobs report was followed by a larger than expected rise in CPI and PPI. Retail sales jumped 0.8% in October, and the September series was revised to flat from minus 0.2% down. It's the first increase since April pre-Christmas. Separately, the UK government reported that the cost of servicing the national debt has risen more than threefold over the past year, leaving the budget deficit higher than anticipated. It appears that the swaps market is pricing in a 15 basis point hike in the December 16th Bank of England meeting, though some are talking about a much bigger move. Now, in Asia Pacific, stocks were mostly up on Friday after US shares closed at a record high during the previous session on Thursday. However, caution over Chinese shares listed in the US did cap gains. Japan's Nikkei 225 was up 0.5% to 29,745. There, October CPI was largely in line with expectations. Surging gasoline prices at 7-year highs helped keep the headline rate positive for the second month, up 0.1% year over year. Excluding fresh food, the core rate was steady at 0.1%. However, the deflationary forces are evident when fresh food and energy are removed. The measure deteriorated to be minus 0.7% down from 0.5%. That's the most since June, when it was down 0.9%. And also, the Prime Minister unveiled an overall package of 78.9 trillion yen, which is around 690 billion US dollars. It is larger than the previous two pandemic packages. Fiscal measures refer to spending, investment and loans, and this is seen to be around 55.7 trillion yen. Now, it's not clear yet how much represents new spending as opposed to the reallocation of funds from earlier budgets that were not used, but it does appear to be about 32 trillion yen of new spending. In China, China's Shanghai Composite rose 1.3% to 3,560. Chinese shares listed in the US fell after e-commerce firm Alibaba slashed its outlook for fiscal 2022, revenues citing intensifying competition, dwindling consumer spending and regulatory curbs. And video streaming platform operator Bilibili also saw its shares fall. Chinese bank loans to the property sector, though, rose 8.2% through October compared to last year, according to the China Bank and Insurance Regulatory Commission. Reasonable demand from the property sector was met, and loans maintained stable growth during the period, it said. Hong Kong's Hang Seng slid 1.07%, 25,049, and Chinese property stocks posted sudden gains on Friday in Hong Kong, sending an industry gauge up by the most in a week amid investor hopes for some more policy easing. In fact, several Chinese cities reported easing rules for land sales amid waning interest among cash-strapped developers. It was the latest sign of growing pressures on local governments as a housing market slowdown intensifies. China Evergrande Group will be removed from the Hang Seng China Enterprise Index from December the 6th, according to a statement from Hang Seng Indices Company. Despite Friday's gain, the stock is still down 81% this year, helping make the Enterprises Index the world's worst performing major equity benchmark. The property firm will be replaced in the index by Innovent Biologics. Evergrande's main onshore property development subsidiary said it has construction at 63 home projects in Gaozhang, Fengtian, and some other cities in the southern Guangdong province, according to a company statement. The unit reiterated a pledge to deliver quality apartments. And in Singapore, iron ore prices jumped 5.7% to break a 5-week slide that saw prices tumble by about 28%. Now, the Australian share market edged up on Friday, buoyed by casino group Crown Resorts, whose shares skyrocketed after US investment giant Blackstone sweetened its takeover bid. The ASX 200 added 0.2% to 7,396, but it was still down 0.6% over the week. Crown Resorts took the centre stage with an eye-popping 16.6% vault to 1154, a level unseen since July, after US giant Blackstone, Crown's second biggest shareholder, bid $12.50 cash per share. Blackstone's third tilt at the James Packer-backed casino giant is 15 cents higher than the previous offer of 12.35 made in May, which was rejected by the Crown Board. Mining company led gains with shares at Mineral Resources up 3.4% at 41.38. Whitehaven Coal was up 3.8% to 2.44, and BlueScope Steel rose 2.4% to 20.71. Rio Tinto edged up 0.8% to 90.25, and BHP was up 1.1% to 36.45. The heavyweight financials category ended the session flat, but CBA remains below recent highs following its recent results, which highlighted margin compression despite volume growth. It closed at 97.81. Treasury Wine shares rose 4% to 12.01 after announcing its purchase of Frank Family Vineyards on Thursday. Shares in footwear retailer and distributor Accent Group recovered from early losses after announcing its sales, and gross margins were significantly affected by mandated store closures during the lockdown, resulting in an EBIT around $40 million below management expectations. The stock ended up 4.3% to 268, and technology stocks were the poorest performers, with WiseTech Global the biggest laggard, tumbling 2.5% to 57.27 after reaffirming its guidance at its AGM. Next DC, however, inched up 0.5% to 12.68 after the CEO said the company had made a strong start towards meeting its financial year 22 guidance at its AGM on Friday. Next DC is expecting EBITDA to rise between 19 and 23% and capital expenditure to be in the range of $480 to $540 million. But Afterpay was down 1.8% to $116.42. In fact, an estimated 500,000 Australians have moved away from credit cards and personal loan debt, according to a new study by Equifax. The change appears to have been spurred in part by the Early Super Access Scheme. The program, which was available from April the 20th, 2020, allowed Australians to access emergency super withdrawals to mitigate the economic effects of the COVID-19 pandemic. That correlates with the peak of closed credit cards and personal loan accounts during the time frame examined by Equifax. There's no doubt the Early Super Access Scheme has made a marked effect on the superannuation market, said Kevin James, General Manager of Advisory and Solutions at Equifax. Our data shows closed unsecured accounts peaked in the first 3 months after the scheme came into effect, likely accelerating the trend we are already seeing in this space. Australians used these emergency funds to get on top of their finances by paying off their personal debt rather than increasing their discretionary spending, as some originally feared. Total credit card and personal debt fell by 13.2%, equivalent to around $20.8 billion, according to Equifax. Average individual debt decreased by 8.4%, or about $1,400. The data demonstrated a steady decline in personal loans and credit card usage overall, despite the financial challenges many experienced during the pandemic, Equifax said. While the average credit limit for newly opened credit card accounts was steady at $8,700, the number of Australians with multiple cards is on a steady downward slide, with many seemingly to want to streamline their options by closing their additional cards. That also contributed to declining credit card usage during the pandemic, Equifax said. Mortgage borrowers were a key group that were less likely to have a credit card. Among those under 30, credit card holders declined by 24%, while card holders declined 12% among those between 30 and 40. Though we have been observing the shift from credit cards to buy now, pay later services for some time, particularly among younger consumers, the pandemic has accelerated the decline of the rainy day credit card, James said. It's encouraging to see that Australians have taken positive steps to pay their debts, avoid credit traps, and improve their financial health. We anticipate this trend will continue. The average limit for personal loans has increased from an average of $16,300 in January 2020 to $19,400 in July 2021, Equifax reported. This is likely because personal loans have benefited from the strength of the used car market and home renovations, the study said. And finally, house price growth is expected to peak this month or next. Sydney will tap out at around 27% before moderating to 6% nationally next year and falling by 4% in 2023, according to ANZ. Nationally, the housing boom will lift prices to just above 21% by the end of this year, in the strongest growth since the 1980s boom. But a slowdown is in sight, with tighter credit, rising fixed mortgage rates, and a large increase in stock on the market combined with decreased affordability all set to dampen price growth in 2022, ANZ said. In 2023, we see prices falling modestly as higher fixed rates really start to bite. Capital city prices are expected to pick up by 6% in 2022 as the post-pandemic boom cools. The strongest gains will be made in Brisbane with a 9% rise, Hobart up to 8% and Melbourne rising by 7%. Sydney's long surge will moderate to 6%, ANZ said. The recent weakness in housing finance suggests that price growth will slow over coming months, they said. New lending finance to owner-occupiers has already peaked, while first home buyer finance has been trending down since its peak in January. Home lending to other owner-occupiers has fallen 10% over the past 2 months. Growth in investor lending is positive after more than doubling in a year to May. While affordability constraints and a better supply-demand balance will help slow the market, the path of interest rates will be critical to developments in the housing sector, they warned. The ANZ analysts expect the Reserve Bank of Australia to leave the cash rate on hold at 0.1% until the first half of 2023, but the economists noted fixed mortgages are already rising. A faster-than-expected rise increases the risk that prices slow more than we currently expect and vice versa. Rising immigration might provide a bit of an offset to dampening domestic demand, but we're doubtful it will be enough to give the evidence over the past 2 years that interest rates trump population growth when it comes to housing. And by the end of 2023, ANZ is forecasting prices nationally to have fallen by 4%. Sydney's prices are expected to be down 4% and Melbourne by 2%. Another key factor in the house price mix is the extent of macroprudential curbs imposed on lending by APRA. Early last month, APRA lifted the interest rate serviceability buffer by 50 basis points from 2.5 to 3%, and the regulators also outlined how further intervention could be orchestrated, including limits on high debt to income or high loan to valuation ratios. Since the end of the 2017 correction, capital city home values have climbed by a robust 30%, but financial conditions are already tightening and the market may do some of that work for it, the ANZ economist wrote. Indeed, the rise in fixed mortgage rates over the past few weeks may see lending state the need for further macro-prudential measures. So there's a couple of observations. Firstly, on the ANZ, of course, they are conflating unit and house price growth. The truth is, of course, a lot of the momentum in prices has been in standalone houses. Units are a different story altogether. In many cases, they are now falling quite fast. So, in a way, top-level data tells you nothing at all. But, in line with my expectations, the rate of change on prices will ease back and could well fall ahead. But more broadly and internationally, the resurgence of COVID as a thematic is pretty concerning, insofar that if COVID does depress activity and momentum and growth, central banks will go on printing. And if central banks go on printing, they won't put rates up, and that could have an interesting impact on the market. On the other hand, if central banks are bounced into rising rates because of inflation expectations, then that could be very damaging to markets. So as I said at the start, strange attractors. On one hand, inflationary pressures and potentially cutting quantitative easing. On the other hand, COVID infections are pulling in very, very different directions. That's why the complexity level just went up a notch. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.